Chevron, the second largest oil company in the US, a dividend aristocrat with 39 consecutive increases. And the company has just completed the biggest deal in its history. The acquisition of Hess for $53 billion. This means they now own a share of the world's most valuable oil field, Guyana. But the stock is near its all-time high, and the P/E ratio is at 30. And the payout ratio is over 100%. Is Chevron the safest haven in the energy sector, or are you paying too much for security here? Chevron Corporation is a fully integrated energy company headquartered in San Ramon, California. The company operates in 3 segments: upstream, downstream, and chemicals, plus a growing new energies division. The core of the business lies in the upstream segment. In 2025, Chevron produced an average of 3.7 million barrels, oil equivalent per day, a record and 12% more than the previous year. The most important production regions are the Permian Basin in Texas and New Mexico, where Chevron is one of the largest producers. Then Guyana through the Hess acquisition. Chevron now holds a 30% stake in the legendary Stabroek Block, one of the most productive offshore fields in the world, with over 11 billion barrels of discovered reserves. In addition, there is the Gulf of Mexico, Kazakhstan with the Tengiz project, and Australia with Gorgon and Wheatstone, 2 of the largest LNG facilities in the world. In downstream, Chevron operates refineries in the US and Asia, as well as a global lubricants and chemicals business. The downstream segment is the stabilizer. It continues to generate cash flow even when oil prices fall. What sets Chevron apart from most upstream companies featured in our series is that this is not a small cap explorer in the jungle. This is the number 2 in the US with a market capitalization of nearly $400 billion. A balance sheet like a fortress and a dividend history that is second to none. Let's also take a look at how I am invested here. In total, I hold 2 shares. Currently, at 124 euros, I'm up 40%, and I've already received a net dividend of 8.88 euros, currently still a somewhat smaller position. If there is a pullback, I am definitely ready to buy more here, but I do want to make sure of that first, that the stock is attractively valued based on fundamental data, or rather, that the price is favorable. We'll take another quick look at that later, where I see my opportunities to buy more. For my fundamental data, I work with Investing Pro. If you also want to use Investing Pro, he says, there's a flash sale with a 55% discount, plus, through my community bonus, you get an additional 15% on top. The 52-week high and low are currently at 115 euros and 175 euros. So you can see we're currently at the 52-week high, so let's dive in. The game changer for Chevron was the acquisition of Hess Corporation, which was completed in July 2025 for $53 billion after an arbitration process with ExxonMobil was decided in Chevron's favor. ExxonMobil had claimed a right of first refusal on the Guyana assets, but failed before the ICC. So what did Chevron get out of it? 30% of the Stabroek Block in Guyana, one of the most profitable oil assets in the world. The block has over 11 billion barrels of discovered recoverable resources with break-even costs below $35 per barrel. That is world-class. Currently, the block is producing from over 3 FPSOs, and in 2026, the 4th FPSO will come online, with the 5th and 6th in planning. The target production for Guyana is 1.2 million barrels per day by 2027. That would be more than what many medium-sized oil companies produce in total. And best of all, Chevron expects up to $1.5 billion in annual cost synergies from the Hess integration by the end of 2026. Guyana is to Chevron what Permian is to the decade of 2015 until 2025. The growth engine will only work with better margins because offshore shale mining in Guyana is significantly more profitable than onshore shale mining. Now let's look at the numbers. Revenue has been $189 billion since 2025, a decrease of 7% compared to 2024. Driven by lower oil prices, but production was at record levels. What means? The volume is correct, only the price was lower. In the fourth quarter of 2025, profit was $2.8 billion or $1.39 per share. Adjusted, it was $3 billion respectively, $1.52, which beat analysts' estimates of $1.45. Operating cash flow in Q4 was an impressive $10.8 billion. For the fiscal year 2025, Chevron generated an adjusted free cash flow of $20 billion. That's an increase of 35% compared to the previous year. And that's despite oil prices being 15% lower. This demonstrates the strength of the integrated model. Higher volumes compensate for the lower prices. However, the valuation is ambitious. The PE ratio is around 30, significantly above the historical average of 15.6. The EV over EBITDA is at 11.6, while the sector average is about 6. The forward PE of 25.5 is lower, but still a premium. That's a critical point. The payout ratio is at 104%. This means that Chevron is currently paying out more in dividends than it is generating in profits. In the short term, this is sustainable due to strong cash flow, but in the long term, it will require either higher oil prices or profit growth from Guyana. The balance sheet is one of the strongest in the energy sector. The debt-to-equity ratio is only 0.24, lower than practically all peers except ExxonMobil. This means Chevron has financial leeway to pay dividends and buy back shares even during a downturn. The capex budget for 2026 is $18 to $19 billion at the lower end of the long-term guidance of $18 to $21 billion. Of that, around $17 billion goes into upstream projects, about $6 billion for US shale, $7 billion for global offshore. Projects in Guyana, the Gulf of Mexico, and the eastern region, and the rest for Kazakhstan and other regions, only about $1 billion flows into downstream. The buyback program is massive, $10 to $20 billion per year until 2030. In Q4 2025 alone, Chevron invested $3 billion in buybacks. This continuously reduces the outstanding shares and supports earnings per share. The dividend was increased by 4% in March 2026, raised to 1.78 per quarter. That corresponds to 7.12 per year and a yield of 3.6%. 39 years of uninterrupted increases, 113 uninterrupted payments. That is dividend aristocrat status at the highest level. But here, as a dividend investor, I have to be honest. With a yield and cost of 3.6% and a payout of over 100%, this is not a typical high-yield pick for my portfolio. The safety is high, but compared to many of our upstream picks, the yield is modest. Now let's move on to the risks. First, the valuation. A P/E ratio of 30 for an oil company is historically unusual. The market is pricing in the Guyana growth story here, but if oil prices fall or production does not meet expectations, the stock has significant downside potential. Second, the payout ratio of over 100%. Yes, the cash flow comfortably covers the dividend, but if this continues for several quarters, the pressure will increase. The World Bank is forecasting the lowest commodity prices in 6 years for 2026. An environment in which an excessive payout ratio could become dangerous. However, as things stand right now, we are definitely not in that situation. Let's just wait and see what 2026 brings. Permian Plateau risk. The Permian Basin is Chevron's most important US production region, but there are increasing signs that production growth there has peaked. The best drilling sites are becoming scarcer and decline rates are rising. 4. Energy transition. Chevron is investing in new energies, but the share of the total budget is minimal. If regulations are tightened or carbon prices rise, part of the reserves could become stranded assets. 5. Major integration risk. $53 billion is an enormous price. The synergies must be delivered and Guyana's production must meet expectations, otherwise the deal was too expensive. Chevron is the opposite of PetroTal in an upstream series. Instead of deep value and high risk, here you get quality, stability, and growth, but at a premium price. The Guyana story is real. Production will grow by 7 to 10% in 2026, driven by the Hess assets and new offshore projects. The balance sheet is a fortress, and the dividend is as secure as with hardly any other energy stock. And the buyback program of $10 to $20 billion per year pushes earnings per share higher. But with a PE ratio of 30 and a yield of 3.6%, it's definitely not a bargain. For my dividend portfolio, which focuses on yield and costs above 8%, Chevron is currently not a buy. However, anyone looking for a defensive energy stock with growth potential and willing to pay for quality will find one of the best values in the sector here. Fair value based on historical multiples and consensus estimates is between $160 and $220. Currently at 108. The stock is in the upper half of the range at 98, so it's not exactly a bargain. Next earnings are expected at the end of April 2026. The first quarter figures could show whether Guyana is delivering the expected growth impulses. As I promised, let's take another quick look at the analysis where, if necessary, I would consider making an additional purchase. You can see that. Otherwise, let me just quickly scroll in for a moment. So my entry point would be, let's say, in the ideal range, around 160 euros, something like that. So at $158.28. At the 61.8% Fibonacci retracement, I would probably be more likely to buy more here. Honestly, anything above that is just too expensive for me at the moment, and I simply see my opportunities in other upstream stocks that are still cheaper right now. But yes, if oil were ever to crash, which of course can happen, below $50, in my view, it would definitely be a buy. I think at that point, probably everything would fall. It would take everything down with it. In my opinion, it would probably be one of the last to fall because, as I said, it is such a stable fortress. But those are exactly the numbers where I would buy more. At $158, as always, this is of course not investment advice. This is purely for information. Everyone is of course responsible for doing their own research. If you enjoyed the video, I would appreciate a like at this point. Otherwise, let me know if you would now buy more Chevron or if you would prefer to wait until the price drops further, or if you perhaps see your opportunities elsewhere. If you are not yet a subscriber, I would be happy if you became one now. Otherwise, as always, I wish you successful investing and see you next time.